The Taiwanese index is down 0.75%.
The supports here below the 40 hourly come in at 53,500.
You're seeing that the stars are aligning for this one.
Maybe Fintech would probably be a minority investor.
Very important signals that I think markets have been waiting for.
85,300 on the Sensex.
The month of September is headed on a stronger note.
CA was investigating this case since 2020.
Things are getting a bit painful for our markets now.
We are now on a long-term bull market for India.
The real truth is cash, everything else is a crash.
The CDSCO declared over 50 drugs as not of standard quality.
Nifty is below the 25,900 mark.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that is the day so far, and it has essentially been a down and out day. This is Closing Bell, last hour coming up. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Rima here. And good to have Rima back after a bout of illness. So good to see you back on the show. And of course, Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. And I think Nigel is the bright spark in otherwise gloomy sea of red, right? Because we're not used to days like this. Near 400-point drop on the Nifty now.
I mean, yeah, absolutely. I have to first, yeah, sea of red and bright spot also. I agree with both points. I mean, it's down, isn't it? I mean, about 1.5% lower on the Nifty right now. That's 1.5%, and you know, market breadth is weak, and it's actually market breadth is not that weak. So it's like actually large cap kind of weakness. Broader markets are not doing all that well either. But a lot of the weakness is in the slightly larger names here. So pockets, if you want to look at real estate, auto, private banks seem to be the most under pressure. We've also, by the way, slipped under 26,000. So 26,000 came last week, and then 26,200 came last week. So there was a bit of a big move that we had, and today there's that pullback which seems to be happening. Where do supports come in? The 20-day on the Nifty, I think that's the major support. Hourly averages, etc., have all sort of disappeared. So the 20-day, now you got to look at that one, which is 25,500. This is, as of yesterday's close, slightly different as if you look at it now. That is one. And the Nifty Bank 20-day moving average comes in at about 52,480. So these are the two broad numbers on the Nifty and the Bank Nifty, which perhaps should act as a support level. And of course, unless and until you've been hiding under a rock, the big story over the last 6-7 days has been China. And the Chinese markets continue to rally 10% on mainland indices, that is Shenzhen, Shanghai Composite, and the Shanghai property market. Because remember, we've been detailing what's happened over the last last Wednesday, Thursday, Friday in terms of measures. Over the weekend as well, there were measures, and specifically with regards to some large cities in China relaxing property restrictions, which we discussed in the morning. And I just found this anecdote interesting. The property index there, the Shanghai property index, has hit a 52-week high today, but it also hit a 52-week low just 2 weeks ago. That is essentially how fast this rebound, fast and furious, this move in China has been. So a lot's happening globally as well, with I think Japan down 4-5%. But here there is some pressure coming through. Rima.
And at the day's low now, it's 25,800 on the Nifty. At no point through the day have we seen any kind of a recovery pull back. It's been a one-way sliding lower kind of a market and a day. A couple of factors at play. One, even rising Middle East tensions. They've been on the boil over the weekend. So that is another factor at play. Secondly, perhaps money is moving out of China, moving into China and Hang Seng away from India. Look at the way this month, the Chinese markets are up 15-20%, while India is only up 2.5%. So maybe the rotation's taking place. China, remember, was under-owned. There was a high shot, there were lots of shots in the market there. So the positioning was negative. And in the last few days, we've seen that flurry of money going into China. And then maybe there is some nervousness ahead of big events this week. It's just the start of the week. We've got the Jerome Powell speech towards the end of the week. We'll cap it up with, the non-farm payroll data. So the labor market will be active and expectations will be watched closely.
Absolutely. I'll be quite keenly watching the institutional flows today and to see what the FI number is going to be like, because we had a sell number even on Friday. But this is big. This is sort of a big, clear, large cap selling, and it's across the board. It's not as if any sector is really providing any sort of a meaningful counter. Bank Nifty is down 1.5%. And look at the other side, the red side of the screen. There is a Hero Moto. There is a lot of auto, actually. M&M, Bajaj Auto, all those names, banks we've discussed. IT has failed to provide any sort of comfort or any sort of cushioning. I mean, there was an attempt in the morning, but none of that has worked. If you look at stocks like TCS, Infosys, no meaningful sort of upside. In fact, the IT index also at the lowest level of the day. The only thing that's seeing buying in the large cap space is metals. That continues to be a global story. And a little bit of pharma and FMCG, so-called safe havens. Other than that, it's an all-out down day on the large cap screen. And the big question is whether FPIs, who are anyway neutral to slightly underweight on India, but if they're holding positions in India and sitting on fantastic gains, would they want to book some profits and shift that money elsewhere, at least a tactical trade, get into China? So let's see how the FPI numbers shape up in the coming few days. But yeah, large caps selling. What about mid caps, Nigel? What's on your radar?
Well, I'll tell you what, for a market that's down 1.5% or effectively 375 points odd, if you said that the breadth of the market is 2:3 in favor of the declines, you'll say it's not too bad, right? If you're seeing the headline index fall to this manner, even the Nifty Bank is down 1.5% or thereabouts. So I don't think the breadth of the market is that bad. And there are select stocks that have seen a good recovery from the low point of the day. Let me just pull a couple of them up. Mara Raja, I recall the stock was down 2% earlier today. That's seen a 4% recovery from the low point of the day. Let's just pull up the intraday chart out there. Coforge is the other one that's seen a good bounce from the low point. And Dalmia Bharat, we had made this point on Bazaar a few days ago, that it was showing signs that, in fact, it would want to take support at crucial technical levels and bounce back up. So Dalmia Bharat is, well, these are pockets of strength in otherwise a weak headline market. But the one that I'll track very, very closely is HDFC Bank. It's holding at around 1,730, beg your pardon. But the 20-day MA is at around 1,690. So HDFC Bank is the one that the bulls could turn to. Let's see how this one shapes up. It's been a bit of an outperform on the last 2-3 weeks or so. And I think the 1,690 odd mark, that's crucial from a bullish perspective for the stock and for both the key indices as well. So keep an eye out on that one. Well, let's get in Mitesh Thakkar onto the show. Hi, Mitesh. Good afternoon. Well, it's been a bit of a down day today. But what's your take? You were talking about the 25,800 level. We're there right now. Would you initiate a long position, or would you want to wait by and then get in at a lower level?
Good afternoon, Nigel. So on the index, I don't think so. I still am watching and hoping that this level holds, because this is an important level for me. But on select metal names, I think, and sugar names is where I'm looking for long positions, purely because of the fact that both metals and sugar in the last 3-4 days have come into an outperformance mode. So I think they will fall less, and in case the market rebounds, they'll move faster on the upside. So that's where I think, some fishing can be done. I have one buy and one sell call right now. SBI Life is, turning slightly negative. So a sell here with a stop just above levels of 1870. 1871, or look at a target of around 1800 or below that. And on the metals name, Vedanta is something which I would be comfortable taking a long position with a stop at 500 for targets of 535.
Okay, Mitesh, thank you very much for that. Let's talk about the auto sector. The Nifty Auto Index, it's down more than about 2%. Individual two-wheelers like Hero MotoCorp down more than 4%. Bajaj Auto is sulking by nearly 3%. And there are some reports which suggest that discounting in two-wheelers in particular has gone up ahead of the festive season. Vinny joins in for more. Vinny.
Yeah, so we have a brokerage note that's come in from UBS on two-wheelers specifically this morning, highlighting that the discounting, especially during festive season, has gone up for two-wheelers. We have seen this come in as a trend previously in passenger vehicles. Now, two-wheelers seems like that's following suit, and especially when you look at it in terms of e-commerce platforms during festive season, we have seen this discounting trend increase. Let's talk about some of the high discounting. One is higher discounting is coming in from Hero MotoCorp. It's in the range of around 11 to 18%, while also in terms for Bajaj Auto, it's in the range of 12 to 16% as well. On the other hand, electric two-wheeler vehicles, they are significantly below the pricing in terms of ICE bikes, or motorcycles that you're looking at. So yes, that is something that we are watching out for. Other than that, TVS Motors, that's managing to gain share, while Hero Moto is actually losing their market share. So yes, Hero Moto is the one that is under pressure, and UBS is maintaining a sell rating on Hero Moto as well as Bajaj Auto, while a buy rating for TVS Motors and Eicher Motors.
Okay, thank you very much for that. There's no sort of buzz, right, ahead of the festive season, any kind of pre-buying. Tomorrow we'll get the monthly sales numbers for the month of September. Sudeep Bandopadhyay from Indie Trade Capital is now with us on the show. Sudeep, two-wheelers have had a pretty good run, but now there are reports of increasing discounting, which is visible. Do you like two-wheelers? Have you done any channel checks?
We do like two-wheelers, and we were all expecting that post-monsoon and recovery in rural demand, we will see pickup in demand in the festive season. And one of the beneficiaries was expected to be Hero MotoCorp. But I think the channel checks are not showing a pretty picture. There is a lot of discounting happening, and there is a lot of inventory in the pipeline. So we'll have to wait and watch. I don't think I will like to venture into any of the two-wheeler companies at this stage. If somebody is aggressive, they can still take a bet on Hero MotoCorp. That's what I feel. But otherwise, it's better to be a little careful on the two-wheeler, considering what's happening in the market. As far as four-wheelers are concerned, I think Mahindra is one stock where we are still positive. We believe that pickup in tractor demand in the festive season can take the script to a different level.
Okay, all right, got that. By the way, I was just taking a look at the move on AstraZeneca, and Ekta, of course, had a chance to catch up with the management as well. And AstraZeneca is absolutely a rocket move right now. Not a stock that we discuss too often, but it's a major one. And look at that, I saw it up about 8.5%, 9%. It's already up 12%. So I just want to highlight some of the key takeaways from the commentary and the conversation that Ekta had with the AstraZeneca management. Remember, the move started last week when they got the approval to import one of their key cancer drugs and sort of have a wider use here in India. The management went on to tell Ekta that they are looking at bringing in 15 new medications into the country. They have approval for 9 out of the 15, and they're hoping to get more. And then on the back of this, they're expecting great growth in the Indian market in areas like oncology, of course, rare diseases, respiratory diseases and ailments. So it's sounding quite optimistic on this one stock. Just very quickly, so the Pharma also is hitting the right notes, right? The market mood is changing from overly aggressive to a bit more defensive, a bit more sort of granular. So AstraZeneca, in case you've had a look at the company at all, or any other pharma stock that you would watch out for or that you like?
No, we did look at Astra, and I think because of the reasons you mentioned, they've got a slew of approvals for introducing some of the very critical drugs in India. And I think that's a very, very good news for this company. But I think the impact of this is going to be for a very short period of time, at least the price impact. And I think the stock has already run quite a bit. So I don't think I will recommend a fresh buy there. But one can start looking at the large Indian pharma companies which have got a significant presence in US. The generic pricing pressure, which was very much there in US, is to an extent receding, and the numbers of Sun and others clearly reflect that. So, one can start taking position in Sun, both on the basis of their US business as well as domestic business. Domestic business very clearly across the industry is growing at a 25% CAGR. So companies having significant domestic business are going to do well over a long period of time. So Mankind Pharma is our favorite for quite some time. So one can keep looking at Mankind Pharma, Sun, and some of the other names, including Cipla.
Hi, good afternoon. I wanted to ask you about the metal space. Everyone's talking about the...
Okay, I think Nigel, I think we'll just go back to Nigel in a bit. Seem to have a bit of an audio issue with him. But the other sort of story that we are tracking today, beyond all the stock moves, is the all-important Sebi meeting. The Sebi board will meet today. And this is the first official meeting of the board of the stock market regulator, the securities market regulator of the country, since Hindenburg raised allegations against Sebi chairperson Madhvi Puri-Buch. We have our colleague Shivani Bazaz here with a heads up and a possible peek into what could be on the agenda. Shivani, take it away.
Yes, Yes, Sebi is holding its first board meeting today since the conflict of interest allegations surfaced against chairperson Madhvi Puri Butch by the Hindenburg Research, which was followed by a series of scathing attacks by the opposition, and also the first time after close to 300 Sebi employees wrote to the finance ministry about an alleged toxic work culture at the organization. Although these acquisitions aren't formally the part of the agenda, sources suggest that the board is likely to take cognizance of the issues, especially the conflict of interest allegations against the Sebi chair. On the formal agenda, several key proposals are up for discussion today. Sebi may discuss easing regulations for rights issuances and allow promoters to transfer their rights and entitlement to select investors. Also, the new asset class could be introduced aimed at bridging the gap between mutual funds and portfolio management services with investment limits, as we know, between 10 lakh to 50 lakh rupees. Sebi is also likely to deliberate on the mutual fund light regulations today. Remember, a consultation paper was floated on this a few months back. This was aimed to encourage more passive funds participation in the industry. One of the things that was expected but is not likely to be taken up in today's meeting is the rules for future and option trading. The meeting is critical today because it is coming amid many controversies and a lot of interest there today. What we are also learning from sources is that there is no press conference expected today, only a press release by the regulator on the discussion and decisions made today. The press release is expected to be out later in the evening today. Back to you.
Okay, thank you very much for that. So no press conference, only a press release. And as Shivani has picked up, perhaps the Sebi will not deliberate upon tighter regulations for futures and options. But you never know, right, till it's done and we have greater clarity.
So, the F&O bit, right, it apparently does not need to go to the board.
Okay.
So it won't be taken up. So it's very unlikely what we're given to understand that it will be announced today.
Okay.
Because the market was down like this. A lot of people were speculating where maybe the F&O rules are coming and hence the market is down. But that is not, I'm only saying not today.
Not today.
But I think it's imminent.
Considering the pace at which they keep coming out with these reports of 91% lost money and 93% as the latest number, lost money in F&O, and institutional investors are the only ones gaining. Never say never.
All I'm saying is not today.
Not today.
But I think, I mean, if you to put my neck out, I think this week. So we'll see.
Okay. Yeah. You know, in fact, when we chatted with Mark Mobius earlier, and we asked him about the risks, right? Because he's very bullish on India. And the only one that he highlighted was, you know, tighter regulations by SEBI on F&O. And that also, he said, will cause a temporary correction. He doesn't expect a big pullback, a big correction on the back of that, but it will hurt sentiment. In fact, let's get you the CNBC-TV18 exclusive Mark Mobius of Mobius Emerging Opportunities Fund. He's very bullish on India's long-term structural story. He expects Sensex to hit 1 lakh level by the end of this year.
Now, the problem facing India, as Sebi has pointed out recently, is derivatives have become too big. There are too many people gambling on derivatives, and that could put a damper on the market. So we have to watch what measures Sebi is going to take in terms of the derivatives. When that happens, you'll probably see a downturn in the market, just temporary downturn, but you'll see some correction in India. Nevertheless, we are now on a long-term bull market for India, and I see the Sensex index going up to 100,000.
Okay, interesting comment there. Sudeep, sorry, I think now I'm back with you. Sudeep, on the metal space, what do? You know, that one, valuations aside, once it gets its momentum, then we see metal stocks do well. Now, from today's high, a few of these stocks have already slipped. Nalco is almost into the red. Vedanta dipped into the red. And these stocks have had a good run, and they have, you know, combated that Supreme Court verdict that we saw with regard to the retrospective taxation that could be deployed in it, and also sentiment was quite weak. What do you do, and what do you like from the space? If you've made a good 10-15% in the recent past, will you take some money off the table, or do you look to ride on this?
As far as metals are concerned, Nigel, at this stage, I will not like to take my money out. I think, the China stimulus and China excitement is real. They are finally trying to do quite a lot of things, and all at one shot. Everyday measures are getting announced. Even the weekend measures were being announced. So for some time, I like to wait as far as metals are concerned. Little bit of turbulence here and there, I will withstand that. But if you're talking about medium to long term, I think my bet is on aluminium, and I think I discussed this. I believe there is a structural shift to aluminium from many other metals. Whether you look at the entire EV chain, you look at the entire electronic goods chain and many, many other industries, the use of aluminum is increasing by leaps and bounds. And the aluminum manufacturers, the entire aluminum value chain will benefit over a long period of time due to this shift. So, Nalco, Hindalco, Vedanta has been my favorite as well, can definitely be picked up for a medium to long-term perspective.
All right, Sudeep, we'll leave it there. Thank you very much for joining us, and it's great speaking with you. Appreciate your time here on CNBC TV18. We are down 370 points, which means we're at about 25,800 on the index. So not very much different from when we started the show at 2:30. We'll take a break. Sunil Kaul from Goldman Sachs will be joining us on the other side. That's coming up in just a bit. Welcome back. We're right there, almost like, the tick is pasted on the tape. I mean, 370, 380 lower, 25,800, not budging so far. Incrementally, that is. Sunil Kaul is Asia Pacific Equity Strategist at Goldman Sachs. Sunil, good afternoon. Good to have you back on the program. Thanks for your time.
Glad to be back.
So, two things, right? One, of course, is a lot of talk of whether tactically money is moving to China. Is that at play at all? What are you hearing from your regional desks, if you can? And second is, we just thought this large cap rally was starting, and you got what you got today. How would you look at it? I mean, I think about what 40-50%, maybe more of large cap stocks. I mean, Nifty stocks are just about 10% away from all-time highs.
Yeah, and that's true.
Just your thoughts. Yeah, go on.
Yeah, Prashant, I think on the China bit, I would say, look, I mean, the fact is that they are seeing a very coordinated response on the policy, both on the monetary side as well as on the fiscal side. I think from some of the client conversations we have been having last week, including some of the flows from the desk, I would say people are a little bit sort of skeptical about China on Tuesday, when we had the monetary easing announcements by PBOC in there. And I think the tone at that point was that you need sort of more fiscal push for growth to stabilize. And then I think on Thursday, we actually had the Politburo meeting wherein they sort of pledged to have more sort of fiscal support. And then there were some media reports which are still unconfirmed, but saying that there could be as large as 2 to 3 trillion RMB stimulus, which could come through in terms of recapitalizing the banks, sort of consumption stimulus, infrastructure stimulus. So I think so I think the clients we have been sort of speaking to late last week have been also sort of getting a little bit more comfortable with the fact that if this indeed comes through, it could mean sort of stabilization in China growth, which should be good for the markets overall. Having said that, I think the market had a very strong rally last week. MSCI China was up 17% from the lows. But I think if you put that in context, we had the market coming in from deeply oversold levels, right? I mean, we were seeing valuations at 9 times China in China, and now that's kind of gone from 9 times to 10.5 times. So we still think that it can sort of go to sort of 11 times plus. And so there could still be a bit of tactical rally continuing in China. Positioning from what we are hearing, both from long onlys, but also from the hedge funds, long short managers, is that things have kind of gone from positioning in the bottom half of the decile to like 14-15% in terms of the overall positioning, but there is still some more room for that to improve. So I would say I think you could still see next couple of weeks China momentum continue. The critical thing would be to see whether there is any improvement in the higher frequency data for the month of September, which comes out in the middle of October. So I think in a couple of weeks, the market will start to see if we are seeing some stabilization in the data.
Throw in India there as well, in terms of that feedback. Sunil, point taken, but throw in India into the mix there as well, in terms of flows and what you're hearing. Is it, I mean, so if China momentum continues, does it have to be at the expense of some selling here? Will it be? What's your sense?
So far, we haven't seen, Prashant, anything like that in the data. I mean, last week, I mean, there was kind of flattish flows in India, even though kind of China had a very strong rally, as I mentioned. I would say a couple of things. One, if you just historically went back and looked at China's flows correlation to the rest of the markets, even during the times China has had strong inflows or over the past sort of 10 years or so, I think there is generally a positive correlation to most of the markets in the region, meaning that when there is kind of decent backdrop for the overall region, you start to see flows coming back everywhere in the region, including China and India as well. So I don't necessarily think that flows, therefore, is a zero-sum game, that China inflow means that you have to have outflows from India. I think a large part of that should be based on underlying fundamentals. The other sort of anecdotal or more sort of historical episode I will point to, I think we had 2 recent episodes somewhat in terms of very strong rally in India. One was rally in China. One was in January this year, kind of January to May, that 4-month of rally. China was up 30%. During that time, I think India had less than $1 billion selling in terms of FII outflows, and the markets were still 10% higher because of the domestic flows. And then obviously there was that late 2022, early 2023 China reopening rally, which was kind of a 60% bounce in China. Even then, India, I think peak to trough was only less than 10% down, and then quickly bounced back in the next 3-4 months. So I would say that in general, our sense is that India probably still stays resilient overall. You might see a bit of weaker foreign flows, which is not just because of China. You also have US elections coming up. You have state elections in India. So there's lots going on, because of which you could see kind of tepid foreign buying in general. But our sense is that you probably will still continue to have support from the domestics, and overall, because fundamentals still look decent, market should be able to hold its gains.
Just to complete that point on flows, while your point on passive flows is very well taken, right? And we've had a lot of guests who've been saying exactly this. We were in conversation with Mark Mobius earlier. So the point on passives is fine, because that money will come into emerging market funds. It will come to India also. But what about active fund managers? And this might not start just yet, but what's the chatter you're hearing? Is there some sense to book profits on the active side? Book profits in India, where the markets had a roaring rally, and tactically move that money to China?
Look, there could be a bit of that rotation that could happen, but I think there are a couple of points I would mention here. One is that if you generally, I mean, our view on the overall sort of India positioning side of things has been that overall foreign positioning is still decently light in India, and because a lot of the price action has been in because of domestic flows, as we know, and so when you sort of look at the India's overall foreign ownership, that's still at 11-year lows or close to that. So it's a multi-year low still in terms of foreign ownership. When you look at the EM fund positioning or Asian fund positioning, the fact that India's weight in the emerging market benchmark has gone from 8 to 10%, which was the case about 10 years back, to nearly 20% now. People have been sort of chasing that move, and so at the margin, emerging markets are like less than 100 basis points overweight, which is much lower than what they had historically. And Asian mutual funds are actually slightly underweight India based on the numbers you track, right? So my broader point being, it's not that people have been super overweight India to begin with. And yeah, there could be a trimming of some allocations, which we have seen in the past. But a lot of the overweights we see technically have also been in banks, which have obviously derated quite a bit and underperformed quite a bit. And so beyond banks, we don't see a lot of concentrated overweight positions in a lot of the names within the FII bucket. And so therefore, our sense is that even though there might be some sort of rotation, we don't expect a large foreign selling in Indian markets.
Sunil, hi, afternoon. Getting back to that point on China, the two recent episodes you indicated in January of 2024 and even towards the end of 2022, when we had those sharp China rallies of 30 and 60% respectively, they were short-lived. They were tactical in nature to some extent. Is it going to be the same this time too? That, that up move in Chinese markets continue, but it's not that like we're at the start of a structural bull run in China. So do you think the measures also that have been announced so far, the coordinated response, is enough to get them out of a slump and start a bull run for the Chinese equities?
Look, I mean that's a great question. Our sense still is that you got structural challenges in China in terms of slowing growth and sort of weakening demographics. I mean the property overhang is real. I mean what they are doing is a lot of the supply side measures in terms of putting more more money in people's hands, and then at the margin easing some measures in terms of people sort of buying properties. A lot of the austerity measures they have put on property, they have kind of the Chinese policymakers are removing that. But I think it still needs to be seen whether that's enough for stimulating demand, right? I mean, these are kind of more measures on the supply side. There hasn't been enough that has been done on addressing the high inventory we are seeing in the real estate market. So I think there still will be some drag from the property market on the growth, but so far what had been happening is that growth estimates had been coming off. All the higher frequency data was continuing to weaken, and there was a downside risk to a lot of the numbers on the street in terms of government not able to meet even their 5% GDP growth target, which they had. And I think what these measures are doing, they're at least putting a floor on those numbers, and hopefully they should be able to at least meet those numbers. So I think to your point, we don't think it's the start of a structural bull market in China. We still think that there are structural challenges to the growth. But I think a lot was priced in the markets already, with both positioning and valuations at cyclical lows. And so I think what's happening here is that you're kind of taking out the left tail risk out of the market, which is why the market's now re-rating from very low levels. And so that momentum, as I said, could sustain, but then I think the market will need more evidence that A, higher frequency data is indeed kind of stabilizing, if not improving, and B, you should start to see, hopefully, that in the corporate earnings side of things, because I think the reality still remains that if you look at the second quarter numbers, like the June quarter, or for the first 6 months of the calendar 2024, the aggregate China universe, which is around 6,000 odd companies, the aggregate profit growth was 0%. So we had no aggregate profit growth. Obviously, dispersion within sectors, but literally no profit growth for the first 6 months of the year. And most of the sectors, barring internet and a few pockets, were actually still seeing earnings downgrades. So I think we need to sort of move from higher frequency data still weakening, earnings still sort of seeing downgrades, to hopefully things kind of stabilizing. And I think that will give markets some comfort. But I think we are far from calling it a structural bull market in China at the current levels.
All right. Hi, Sunil. Good afternoon and good to see you. Ben, well, that's the reason that India trades at a sharp premium in comparison to China, right? We have earnings growth, political stability out here, and, things have been looking up out here. So better stability, it could be one of the factors that, that's why we are commanding those valuations. We've spoken enough about China. Let's focus on, sectors and themes. Now, we're talking about global-facing themes, and two of them stand out. One is metals, where I think you all had a neutral stance. So with this kind of rally, and if China's going to come back into play, then will you all want to change that stance out there? That's on metals. And what about tech? You all were bracing yourself for a far better second half of the year. Holding on to that thought?
Look, I think on the metals, we still, Nigel, have a market weight stance there. Again, I think sort of if you circle that to the China discussion, also, we don't think this is a huge demand upside for the commodity complex at this point in time, as we spoke about the property market. So I think we still think that for the metals overall, some of the metals, whether it's steel, whether it's iron ore, they're kind of still structurally oversupplied in many of the global markets, including in China. And so I think keeping that in mind, we still think that that the neutral is probably the right stance in there, rather than being sort of overly bullish on metals. On the IT side of things, I would say we had been warming up on the sector, and we had been not structurally, but we have been underweight for most of last year. And sort of coming into this year, we had sort of neutralized that stance largely on the fact that even though you have a couple of more quarters of weakness in near term, you could start to see inflection into the outer quarters. And I think that is starting to play out. But having said that, we still think it makes sense to be much more geared towards the domestic sectors in India overall. And we have a sort of mix of both cyclical and defensive sectors in our allocations. And I think one of the core views, which we just reinforced or reiterated in a detailed note published last week, is that overall we feel that India's profit growth is sort of its sensitivity to the external growth has been coming down. It's kind of much more geared towards domestic growth, and that is already kind of reflecting in the profit pools being shifted. So in the last sort of 8 to 10 years, most of the bulk of the profits were literally coming in from sort of financials and IT, and I think that's kind of shifting already towards some of the investment cyclicals, which includes kind of autos, real estate, power, some of the clean energy side of things, and that's where our sort of positive views have been around. And we do think that over the next not just sort of the next few quarters, but on a more medium-term basis, it makes more sense to be more geared towards the domestic cyclical sectors in the market, and that's where most of the profit growth will come from, and that's which will show up in the underlying stock prices as well.
Okay, so you're sticking to your sort of like for domestic cyclicals, and just another 20-30 seconds left on the conversation, Sunil. What about earnings? It's at the end of the day, earnings are the fuel that power sustained bull markets, right? We're getting into another season. How confident are you about the earnings delivery, and what's the range, say, for the Nifty 50? For your own universe, what's the rough earnings growth that you're still penciling in this year?
Yeah, so if you look at the last 5 years, Surabhi, so we have been sort of, I mean, obviously a lot of volatility with the COVID drawdowns and all, but the last 5 years, MSCI India has basically compounded earnings at 16% CAGR rate. We are sort of penciling in. So the first 6 months of the year, we have around 14% earnings growth. So still kind of numbers coming through. And I think to Nigel's point, the view really is about macro very good, earnings delivery continuing, and then domestic flows kind of supporting the market. Our own sense is that going forward, you can still see mid-teen earnings over the next sort of few years until 2020, 2030, where we have sort of official forecasts out now. And we are up sort of penciling in around 14% earnings growth. So somewhat slower trajectory than what has been in the recent years, part to do with the signs of slowdown in the economy and sort of fiscal consolidation that the government is doing, which might sort of weigh on the growth. But in general, we still feel confident that you could see around 14% earnings growth over the next sort of 4 to 6 years, which sort of should drive markets higher, even with some multiple derating from current levels. So you could still see decent sort of early double-digit returns in the market on a sustained basis. We still have a 27,500 target on Nifty, and we are overweight the market in the context of the region.
27,500 by when, Sunil?
I mean, obviously the markets have been stronger, so that's a 12-month target technically, but it's basically kind of 7-8% upside, which is 13-14% earnings and a bit of multiple compression is how we get to that number.
Okay, Sunil, it's always good hearing your thoughts. Thanks a lot for speaking to us here on CNBC-TV18. China, it may be bouncing, but it still has structural issues. India will continue to see mid-teens profit growth, and maybe, in fact, we could see high single-digit to early double-digit returns on the index. Appreciate you joining in. Well, for the time being, the markets are at the low point of the day. I'll tell you what, we'll slip into a short break. You come back, we'll continue to focus on markets. We'll get back our technical experts as well. Welcome back. Markets at the low point of the day, but it's a good time to find out what's going on in D Street Chatter. Nimish can give us further insight about today's fall. Nimish, tell us, what are you picking up?
Hi, Nigel. It's largely the fall is led by the large cap names. And again, looks like there's a bit of geopolitical risk, which is a big concern there, a bit of nervousness out of the Sebi board meeting as well. And that's been largely discussed as well across all the dealing rooms. So maybe these are the few factors which has led it to a sharper fall in the broader markets, in the large cap names today. Even in terms of flows, I understand there is selling pressure in select large cap names, which includes the large private banks, Reliance. There is selling pressure clearly from the larger FIs today. So that's the reason why you're seeing a big fall in the Nifty. But if you look at the breadth, that's not very weak. There is outperformance in select pockets. Like for example, metals have done really well. Out of the blue, cement stocks have done well today, and so are some of the mid caps as well. So it's not like there is across the board selling. The selling is largely in the large cap names today. That's the overall feedback. The other sector which has been relatively underperforming is the auto names. Across the board, autos have relatively underperformed, largely on profit booking because they've done very well. And now there are reports which are indicating that maybe there is the discounting is going up. There is a lot of inventory as well in the system. So the monthly data on autos will be very interesting to track in the next couple of days. But I guess today's big sell-off seems to be largely restricted to a few large cap names, including the large private bank stocks.
Got it. All right, Nimish, what about individual stocks? What are you picking up?
Well, so the first stock on my list is RBL Bank. There was a large block. 75 lakh shares got changed hands in the afternoon trade. I understand the FI was a seller in today's block, so disclosures could be quite interesting in RBL Bank. So that's the first name. The second stock is GAIL. Within the PSUs, GAIL stands out. It's been outperforming as well of late. I've been saying for a while now that select PSUs is seeing buying interest, and GAIL stands out on back of very strong buy flows today. So that's the reason for GAIL to outperform. And the third name is Varun Beverages. There was an initiating report as well from an FI brokerage, but there is a very large selling pressure in Varun Beverages at an FI. So it looks like at this level some bit of churn is happening within the larger portfolios, and Varun stands out in terms of sell pressure from a leading FI. So that's the reason why it's part of my charter list.
Okay, thank you very much for that. Interesting list as always, Nimish. Mitesh is now back with us for a few BTST calls. Mitesh?
So I have a HCVT on HCL Tech with a stop at about 18.10 and a target of 17.75, 17.70 on the downside. And a BTST on BPCL. That was the oil refineries, metals and sugar, which is doing well. So BPCL can be a BTST with a stop at 365 half, the targets of 376.
Okay, thank you very much for that. Anand Tandon is also joining in on the show now. Anand, what have you made of this collapse that we've seen? Not collapse, but this correction that's set in the large cap names. Anything that you've picked up from your conversations with other market experts?
Well, I try and stay away from what other people say. But broadly, I think, the right question would not be why it is falling. The right question would be why did it rise so far? And, that is something that I found a little difficult to justify, as you are well aware. I don't think that we should read too much into a one-day fall. We have to see whether the trend continues. You have been discussing on what are the issues regarding China, etc., and whether there is a flow out there. You have to keep in mind that, today you have an economy like China, which is 3 times the size of, or 5 times the size of our economy, trading at the same market cap as us. So, obviously the valuation gap is so huge that for anybody looking at it from the outside, China, if it becomes a stock market which is tradable again, given the penchant of the government to try and destroy it, if that thing has reversed, then clearly that will offer a lot more interesting opportunities than India does at this stage, purely from a financial investment point of view.
Right. No, got that. Anand, I think you put the entire market question in a philosophical framework. The question is not now why we are down, but why did it rise so much in the first place? But point taken, and that's one way to look at it. Now, I just want your thoughts on PB Fintech, right? I mean, the stock fell quite sharply last week. We had the management with us. They're investing into a yet-to-be-formed company, and they're going to invest up to $100 million, one-time investment. Just want to play out the sound bites, and then I wanted your thoughts on how to think about something like this. Listen it. Okay, I think we don't have the PB Fintech soundbite. We should have it shortly. Maybe we can ask Anand for your view and then play out the bite if we'll have it ready by then. I don't know if you heard the interview. Basically, the concern is that they're going to build hospitals.
I did hear that, that they are putting money into a healthcare business.
Go on.
So it is, frankly, whenever you have too much money, you end up doing things like this, right? So this is like saying that, Reliance should, since it was making textiles, it should now backward integrate into generating humans. There is no particular reason why you should be, as an insurance broker, be looking at doing anything other than insurance broking. It's a very large space. It continues to be a growth area. For most insurance companies, the opportunity is still very large. And there is no particular reason why you should be necessarily then saying that, I need to benchmark myself. This was, if you recall, some time back, Mahindra Group CEO had come and said that, we are trying to dip our toes into trying to understand banking. And I had commented at that time that for a company which had a Kotak Mahindra investment from the very beginning to say that they don't understand banking is a bit of a joke. I think PB Fintech, to my mind, is doing something similar.
Okay.
To be fair to them, we did sort of get into a lot of the details, Anand, to figure out how this is going to happen. And they did clarify that this will be through a strategic investment in a different entity, which will have its own set of investors as well. And PB Fintech will limit its investment to, a high of about 35% is what they're talking about, at least as of now. Let's actually listen into the management and the rationale behind looking at a differentiated asset-light healthcare foray.
PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. The model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. There's a whole bunch of people that it will speak to. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others.
Okay, that's PB Fintech for you. Everything is down today except metals. The Nifty Metal Index has hit a new high. It's up for the 8th day in a row. And they're going to end September on a very strong note thanks to the China stimulus. Manisha is here to tell us more about what's happening with the base metals. Manisha.
Well, thank you for that. Absolutely. If you look at the last 1 week, the month of September, or the current quarter itself, it all seems to be closing on a very, very strong note there. We have seen the most aggressive of China's stimulus since the pandemic there. So whether it has been about lowering borrowing costs or injecting funds into the economy or even easing mortgage repayments, China has done it all. The street does feel that China isn't stopped or done yet. It could be coming in more strongly when it comes to property sector, because that is one that still needs to be addressed right now. But at this point in time, the sentiments clearly on the positive side. The second thing is that while, of course, the one rate cut has been done, now for the month of November, it's a 55-45 probability that whether you're looking at a 50 basis point rate cut or a 25 basis point rate cut, and that in turn seems to be weighing onto the dollar and supporting the metal prices there. The street also believes that come the first quarter of 2025, the China restocking will come back. And even as China has been exporting a whole host of commodities and metals, the absorption, especially from India and various other countries, has been on the stronger side as well. So those are very supportive factors. We have seen inventories for many of these metals decline as well. Is the reason when you look at the last 1 week, you are looking at 7% of gains in copper and another 8 to 6% of gains coming in for aluminum and zinc as well. For the month of September, the gains have been quite strong. 17% of a jump up coming in for many of these metals, 15% up for copper as well. And for this year until now, we have seen double-digit percentage gains come across board. Anywhere between 11 to 35% of strength is what the metals have seen, with an expectation that the last quarter of this calendar year could see this strength continue to build up on the higher side.
Okay, all right. Got it. Thanks very much for that. Metals indeed have been the shining spot over the last couple of weeks since we started seeing these stimulus moves in China. Let's take a break, come back with more market talk and more perspective on the other side.
Welcome back. Well, the markets are going to be ending at the low point of the day with the Nifty Bank. In a couple of trading sessions, that's pulled back close to around 1,400 points or thereabouts. But we have Anand Tandon still with us. Anand, I wanted to ask you about a few of these themes that are still doing well today. Housing finance companies are doing well. Canfin Homes, that's up close to around 1%. And most of that move has come in the last few minutes in a market that's very wobbly. I think after Bajaj Housing listed, you have a lot of these other companies that have suddenly got some comfort on the valuation parameter. What do you like from the housing finance space?
Well, the sector has been something that I have been saying that is probably one of the better places to be investing in, because while real estate stocks have actually done very well, the reality is that their sales are beginning to ease off. On the other hand, there are still many more self-made houses, etc., which will still be under play, and therefore they will require loans. So probably a better way of playing real estate has been that. Of course, the fact I'm not commenting on the valuations at all. Those are really irrelevant given where Bajaj Housing now trades at. So all of them will look cheap compared to Bajaj, but the question is whether Bajaj should be the benchmark or not. It is a competitive space. It is a space where the margins are going to be somewhat under pressure. But despite that, at least the asset quality is, unless the management does something silly, is likely to be reasonably decent and can continue to grow.
Okay. By the way, I'm looking at the market right now. It's quite crunching, the fall, and we are at the lowest level with no hint, no sign of buying coming in. And once again, the Nifty is struggling to even remain above 25,800. It dipped below that level Look at that graph. Absolutely no hint of buying the lows today. Well, before the market closes out, let's quickly put the spotlight on IOC. The company has decided to withdraw the proposed rights issue of 22,000 crore rupees. Sonal is joining in with this important update. Sonal.
Well, it is important, negative, and something that was largely expected as well. Remember, the government is the promoter and was going to infuse this money into the company. Now, remember, the company has gone ahead. The board has decided to withdraw the proposed 22,000 crore rupee rights issue. That is because the Ministry of Petroleum and Natural Gas has conveyed to the company that the government is not willing to put in that money into the company. And this is because there was no capital support for oil marketing companies in this budget. For last 2 years, there has been no support. So this time it was expected that, yes, government could go ahead and withdraw that support completely, and now it's official. The release says, in view of non-participation of government, that is the promoter, it is withdrawn. And remember, it was approved last year in July 2023. Board has also approved around 18,000 crore rupees for BPCL in terms of rights issue. So I think BPCL will be the next company which could take that decision. Of course, we need the official data from them. But considering that there is no infusion of money coming in from the government, this could happen with BPCL as well. Now, Nuvama in a post-budget document had said that with no budgetary support declared, OMCs are likely to continue to bear losses on sales of LPG, because in their Q1 con call, oil marketing companies were still hoping there could be some support that would come by. But if it doesn't, they will continue to have losses in their LPG portfolio, and that would be a negative.
All right, Sonal, thank you very much for that. So that's the news flow on IOC and, of course, oil marketing companies, etc. as well. Anand, that Sebi board meet is today, and we were discussing this earlier. From what we understand, the F&O bit, which is the most keenly watched, that's not going to come up today. But I think it's imminent. That is imminent as well. Just your thoughts on, because a lot of the detail was out in terms of what was proposed. How much of it will be implemented is another matter. But will it have a market impact when it comes?
Obviously, the Sebi is trying to make a market impact. So I would imagine that if the first round of whatever regulations they pass doesn't have a market impact, the logical thing would be to tighten it further. So till it actually results in what Sebi is trying to achieve. So to that extent, you should be sanguine about the fact that over time volumes or liquidity will reduce in the market. And if that's the objective, the retail investors will probably find it more and more difficult to probably get in and invest through that. Whether that serves the overall purpose of making the market more stable is a different ballgame altogether. But if Sebi has decided to reduce the retail participation, it has all the tools it needs to be able to do that.
Anand, thank you for joining in, counting down to what's been a painful day for our markets. The Sensex